Early February 2026 brought a blunt update from Stellantis and CEO Antonio Filosa. The company disclosed a strategic reset that drove approximately 22.2 billion euros of charges recorded in the second half of 2025, which is roughly the mid-$20 billion range using the euro to dollar rate around February 6, 2026. It also said the reset included about 6.5 billion euros of cash payments expected over the next 4 years, roughly the high $7 billion range, and it said it would not pay a dividend in 2026. Those numbers sit at the end of a chain that started with a confident, time-bound bet on electric vehicles under the original Dare Forward 2030 strategic plan. July 2021 is where the logic begins. Stellantis described the Dare Forward 2030 plan aimed at sustainable double-digit adjusted operating income margins in the midterm, around 2026, and it tied part of that confidence to merger benefits, including a forecast of more than 5 billion euros of annual cash synergies at steady state. The same plan leaned on a cost curve, targeting electric vehicle battery pack costs to fall by more than 40% from 2020 to 2024, plus more than an additional 20% by 2030. If this analysis helps, subscribe. Cost alone was not the full promise. Stellantis also stated it was targeting total cost of ownership, parity between electric vehicles and internal combustion engine vehicles by 2026, which meant the company expected the economics to look mainstream, not niche. Regional adoption assumptions came with it, with low-emission vehicles targeted to be over 70% of passenger car sales in Europe by 2030 and more than 40% of passenger cars and light-duty trucks in the US by 2030. Those targets demanded a portfolio shift on schedule. A slow rollout would not match the math. A single, oversized commitment followed in July 2021. Stellantis decided to invest more than 30 billion euros through 2025 in electrification and software development, including equity investments in joint ventures with partners like LG Energy Solution, and it paired the spending with a battery supply plan sized for scale. More than 130 gigawatt-hours by 2025 and more than 260 gigawatt-hours by 2030 were the stated targets, supported by 5 gigafactories in Europe and North America. Here is what we need to understand. Instead of staging a smaller plan that kept more flexibility reserved for hybrids and advanced internal combustion engines, Stellantis chose an accelerated ramp built to move fast. The ramp depended on repeating the same building blocks across many vehicles, and that choice shaped everything else. Stellantis said the plan included 4 flexible battery electric vehicle platforms, a scalable family of 3 electric drive modules, and standardized battery packs designed to cover brands and segments, which meant fewer unique designs and more shared parts. It also said the roadmap would use dual battery chemistries, including a high-energy density option and a nickel-cobalt-free alternative by 2024. The idea was simple and expensive to reverse. Do the hard engineering once, then reuse it at volume. Supply security and timing sat right next to cost in the 2021 plan. Stellantis stated that solid-state battery technology introduction was planned in 2026, and it said it had signed memorandums of understanding with 2 lithium geothermal brine process partners in North America and Europe, aiming to reduce risk around key inputs. March 2022 pushed the same direction again, with Stellantis stating it was setting the course for 100% of sales in Europe and 50% of sales in the US to be battery electric vehicles by the end of the decade. The plan also set scale in plain terms: more than 75 battery electric vehicles, plus global annual battery electric vehicle sales of 5 million vehicles by 2030. That is an aggressive production and demand target. March 2022 also raised the capacity bar, which meant the system had even less room for error. Stellantis's key facts said it would increase planned battery capacity by 140 gigawatt-hours to approximately 400 gigawatt-hours, and it included a target to achieve 100% of the €5 billion in annual cash merger synergies by the end of 2024. That sequencing carried a clear expectation because synergies and shared platforms were meant to help fund the transition as the product mix shifted. The result was a plan that rewarded steady demand and steady execution. A plan like that punishes delays. By the end of 2023, Stellantis described progress that lined up with the earlier commitments. Annual reporting said nearly one-third of its product portfolio was battery electric at the end of 2023, and it said it intended to launch an additional 18 battery electric vehicles in 2024 for a total of 48 electric models. Those counts are not small. They signal an organization moving from strategy into product cadence, supplier commitments, and factory scheduling at scale. Real-world investment also followed the plan into specific locations. Stellantis's 2023 annual reporting said that in February 2023, it announced a €140 million investment in 3 plants in Kokomo, Indiana, to produce new electric drive modules, connecting the strategy to U.S. manufacturing capacity. The same reporting said that in September 2023, Stellantis announced the opening of its first battery technology center in Italy at the Mirafiori complex in Turin. That combination mattered. More modules and more testing capacity meant the shift was being built into the industrial base, not treated as a side project. On paper, the bet looked internally consistent, because the math connected cost, adoption, and margin. Battery pack costs were targeted to fall by more than 40% from 2020 to 2024, and by more than an additional 20% by 2030. Stellantis also stated it aimed for total cost of ownership parity by 2026. The same 2021 materials targeted sustainable double-digit adjusted operating income margins in the midterm, around 2026, and the plan pointed to more than €5 billion of annual cash synergies at steady state as part of the funding logic. If those pieces landed together, then building toward more than 130 gigawatt-hours by 2025 and more than 260 gigawatt-hours by 2030 could read as disciplined preparation. Miss any one of them, and the plan gets expensive. The slow damage showed up once market conditions and execution drifted away from the assumptions. Reuters reported in May 2025 that Stellantis had lost market share in the US and Europe, and it also reported that dealers complained rising prices at Stellantis's mass-market brands had put vehicles beyond the reach of many customers. Reuters also described bloated inventories of unsold vehicles tied to delays in model launches, disappointing electric vehicle demand, and increased competition from Asian rivals. That mix matters because a scale plan needs clean timing and clean pricing to stay healthy. Inventory and delays are where costs start to stack up. Public signals of a rethink arrived in 2025, and the phrasing started to change. Reuters reported on June 25, 2025, that newly appointed CEO Antonio Filosa said Stellantis had begun reviewing its long-term strategic plan, which meant the company was revisiting the big assumptions rather than just tweaking schedules. Reuters later reported on September 8, 2025, that Stellantis would no longer pursue a target of producing only electric vehicles by 2030, according to its enlarged Europe head. Here is the trade-off we see. Reuters cited 2025 market mix numbers of 19.5% fully electric in Europe and 7.7% of US new car sales, and those shares made an all-electric posture harder to execute on the original timeline. The plan could still be directional. Demand was not matching the earlier pace. Early February 2026 turned the mismatch into a formal reset, with line items that made the change impossible to ignore. Reuters reported that Stellantis announced €22.2 billion of charges as it scaled back its electric vehicle ambitions, and Stellantis detailed the reset in a February 6, 2026 press release. In that disclosure, Stellantis said €14.7 billion of the charges related to realigning product plans with customer preferences and new U.S. emissions rules, largely reflecting significantly reduced expectations for battery electric vehicle products. It also said the realignment included €6 billion of platform impairments due to reduced volume and profitability expectations and €2.9 billion of write-offs related to cancelled products. The same disclosure added €2.1 billion of charges tied to resizing the electric vehicle supply chain, including the dissolution of the Next Star Energy joint venture with LG Energy Solution, and about €700 million in cash payments over 4 years. It said initial actions in 2025 included cancellation of products that would be unable to achieve profitable scale, including the previously planned all-electric Ram 1500 battery electric vehicle, which was replaced by the Ramcharger range-extended hybrid version. To put these numbers in perspective, General Motors took $7.1 billion in electric vehicle-related charges, while Ford Motor Company recorded $19.5 billion, showing this was an industry-wide recalibration. Stellantis described the new posture in plain terms after the reset, and the words showed a clear shift in mindset. In its February 6, 2026 disclosure, the company said the shift puts freedom of choice at the center of its plans, including electric vehicles, hybrids, and advanced internal combustion engines, and it said the journey should be governed by demand rather than command. The same disclosure said Stellantis would not pay a dividend in 2026, and it said its board, led by Chairman John Elkann, authorized issuance of up to €5 billion of non-convertible subordinated perpetual hybrid bonds. The lesson is financial as much as strategic, because when a transition plan is sized ahead of demand, the adjustment shows up as impairments, cancelled products, and years of cash payments like the €6.5 billion expected over 4 years. For more decisions and trade-offs like this, subscribe. The decision was logical. The consequences were not.